If you've been watching your investment accounts more closely lately, wondering when the other shoe is going to drop, you're not alone. While everyone's debating whether we're heading for a soft landing or a recession, there are three specific market trends happening right now that are quietly reshaping how smart investors should be thinking about their strategy. I'm Dr. Keith Grosshans, and I've spent the last 2 years diving deep into alternative investments while maintaining my full-time practice. What I discovered might surprise you. The real estate market that everyone thought would crash, well, it's actually doing something completely different. There are currently 800,000 loans that are delinquent that are creating big opportunities, but most people have never heard of them. And there are big banking sector shifts that could actually benefit investors. So let's talk about it. The first trend is the real estate squeeze, and it's not just prices. Here's what's actually happening with real estate, and why this matters if you're thinking about investing. Instead of the boom or bust that everyone predicted, we're getting what I call the death by 1,000 cuts market. Yes, home prices are growing modestly at about 3 to 4% nationally, but the real story is what's happening to the total cost of ownership. So here's the hidden squeeze. Homeowners insurance has jumped about 24% in just the past 2 years, with another 8% increase projected for 2025. Property taxes have also climbed an average of 27% between 2019 and 2024. And for context, that's about double the rate of inflation. We're also seeing what's called the lock-in effect. Homeowners with low mortgage rates really don't want to sell. And anyone analytical can see that rates went from 2.5 to 6.5% and think, I'm not giving up on my 3% mortgage. But when your insurance goes from $1,600 to $8,000 after a hurricane claim, or your property taxes jump 30% in 1 year, suddenly that low mortgage rate doesn't provide you the protection that you thought it would. So while everyone else is waiting for rates to drop, which doesn't seem to be happening in 2025, there are people who can't wait. There are people facing foreclosure, divorces, job loss, or simply drowning in these rising ownership costs. The second trend is the hidden debt crisis that's creating big opportunities. This number should get your attention. There's 800,000 seriously delinquent loans. These aren't in foreclosure yet. They're actually sitting in what we call shadow inventory. And here's the key insight. FHA loans, which only make up about 16.5% of the mortgage market, account for about 56.7% of these total delinquent loans. So why does this matter? I'll share a real example. Just last week, I was looking at a note deal that was located in Ohio. It was listed on the PaperStack platform. The asking price seemed pretty reasonable. It was offering about a 16% yield, which sounds great on the surface, but when I really started to dig into the details, there were red flags everywhere. It was a brand new note with no payment history, and there was minimal down payment, and it had about a 96.5% loan to value ratio. When you look at that, it's about the same as what you get with FHA loans, as they often can be obtained with only 3.5% down. However, FHA loans come with mandatory mortgage insurance, which protects the lender. However, this was a private mortgage, so there was no mortgage insurance available to provide any extra protection. Because these FHA products allow for such low down payments, it's no wonder that we're seeing so many defaults, because the borrowers have very little skin in the game. I passed on that deal because high LTV with no seasoning is outside of my risk tolerance. And then we have the third trend, which is the financing crunch that's creating more opportunities. This trend that we're seeing is that money is getting tighter across the board. Nearly $500 billion in commercial real estate loans are coming due in 2025 alone. And now, banks are being a lot more picky about who they'll lend to than they used to be. So what does this mean for you practically? Well, this means that traditional real estate investing is getting harder. You need bigger down payments, you need to have perfect credit, and you're competing with cash buyers. At the same time, banks are also getting stricter about lending to individual borrowers who are already stretched thin by these rising costs that I've mentioned. However, with every challenge does come some opportunity. When banks start to tighten up, they also want to clean up their books. This makes them more motivated to sell off non-performing loans at discounts rather than deal with the headache of trying to work them out or modify them. So now we have a little bit of a perfect storm. People can't afford their homes due to rising costs, they can't really refinance due to the higher rates, and They can't sell easily because there's lower inventory due to this, and they can't sell easily as there's not as much demand due to the lock-in effect. Someone has to provide solutions to those borrowers, and that's where the note investing opportunity comes in. So here's how this all connects. Traditional real estate ownership is getting squeezed. There's locked inventory, high rates, skyrocketing insurance and taxes, plus the banks have their tighter lending standards. This is creating a massive wave of distressed borrowers who need solutions. So instead of competing for overpriced rentals, where you'll deal with 6.5% mortgages and potentially $8,000 insurance bills, you can be on the other side. You can become the one providing solutions to people who can't handle these crushing costs anymore. And with notes, you're not managing properties or dealing with tenants. You're essentially providing financing solutions. So if you want to learn more about how note investing works and how to evaluate these opportunities systematically, I've put together some resources below this video. And if you found this market analysis helpful, please hit subscribe. I'll be sharing more real-world investment insights that cut through typical financial guru nonsense. Which trend surprised you most? Drop a comment below.